Welcome to another episode of the Sky Accountants podcast. I'm your host, Ashley Carmichael, Director and Client Manager here at Sky. And today we're talking all things buying businesses. And to do that, I have with me Michael Ferris from Probooks Accounting. Mick, welcome. Mick's
Thanks,
got
Ash.
Mick's got a wealth of experience in helping small and medium enterprises to acquire businesses in the Aussie market, and really glad that you could join us today to share a bit of your knowledge, Mick.
Thanks, Ash, and thanks for having me. Yeah, there's certainly lots of great opportunities out there for those that are looking to get started in business and all those who are looking to grow their existing business by acquisition.
Yeah, that's great. So, Mick, you've been around the block a few times. Tell me, someone's looking to buy a business. How do they sort of zero in on that business and execute that deal?
Yeah, so there's a few ways that you can turn up acquisition targets, if I can put it that way. The secret is really to cast a wide net rather than focusing narrowly. So before I get into that, though, it's really important for you to do a bit of self-reflection and assess your skills, your interests, your financial capacity, those types of things before you decide on the opportunities that you want to pursue. Do you have the know-how about how to run the business successfully? Are you looking at an industry that's healthy and has good future prospects? Can you afford the investment without taking too much risk? That's a big one. It's often quite attractive, isn't it? People think, business is going to make me. But if they bite off a bit too much or more than they can chew in the first instance, that can be a really big risk, sometimes quite detrimental. So, in thinking about can you afford the investment, have you engaged with your lender or your bank to see whether you can borrow some money to get into the business in the first place? So, and then another important thing is, do you want to be active in the business or take a more passive role?
Yeah, right. Yeah, well, look, I know I've seen my fair share, and I'm sure you have too, of, those people who do sort of bite off a bit more than they can chew, take on a business that they don't have the skill set for. And, it becomes a bit of sink or swim, and sometimes they sink, which is unfortunate. But
Yeah,
so,
that's true.
they've done that introspection, as you said, Mick, and they've formed a bit of an idea about what they're looking for. Um, how do they find it?
Yeah, so we live in a very digital world these days. So often the first place is jump on the internet and Google businesses for sale potentially. But yeah, generally, get out there and have a look around and see what you can find that could be available. So there's plenty of business brokers out there who are, their business is moving businesses from one owner to another. So they're going to have some pretty decent marketing and advertising that's readily available. So, search up some local business brokers or even Australia-wide, depending on what business you're after, and check out their websites and see what's available there. And then, if you find one or two or more that seem to have some businesses that, might fit the bill for you, you can consider getting in touch with them and getting on their books, so to speak. So yeah, once they know what you're looking for, then they can keep an eye out and keep their ears open. And if they see something that sort of fits the bill for you, then they can contact you and let you know.
Yeah, look, I found that they're in the business of selling businesses, and they're quite happy to have people on their books. It makes their job easier.
Yeah, exactly.
Mm.
It can also be useful to register your interest with insolvency practitioners,
Mm.
liquidators. They're often on the lookout for buyers to buy businesses who, might be failing, not through the business itself being bad, but through other circumstances and influences. So sometimes that can be a good way to get hold of a bargain in some
Mm.
cases. So a little bit left of center approach, I suppose, but yeah, definitely one worth considering.
Mm. Yeah,
Um,
absolutely.
Another time-honored approach is, to research potential businesses that are not on the market. You might have heard the saying that everything's for sale for a price. So,
Yeah.
um,
Yeah.
yeah,
Mm.
sometimes you can be lucky. You make the right offer at the right time to a particular business owner, and you never know what could happen. So, you can contact them directly, or you can contact them through an agent. You might be able to get someone to act on your behalf if you would rather not deal directly and just
Mm.
express your interest in potentially acquiring their business. So, yeah, I don't think there's any set rules around that. It's about conveying your interest to the
Mm.
potential vendor and seeing what their appetite is to sell.
Yeah, look, I'm a fan of that approach. I think, that old saying, there's no harm in asking. Um, and I like it because it's really deliberate. You're assessing businesses that really fit the profile that you want, and they're the ones that you're targeting. It's rather than just sort of having what's available, you're going after what you want. Mm.
That's right, exactly. And that approach is often a slow approach, but it can be quite good because if you contact a business owner, they might not be ready to sell right now, but anything could happen down the track. They could have some family circumstances, which means it'd be great for them to get out of the business, or they might wake up one day and go, you know what, I've had enough, and oh, that's right, that person contacted me some time ago. I wonder if they're still interested. I'll get in touch.
Yeah, yeah. Well, yeah, definitely worth a look. So, I've, I'm in the market looking for a business. I found something that I'm quite interested in. What next? What do
Yeah,
I
so
do?
yeah, that's right. So you really you need to start doing some analysis around this particular business. So you need to get your hands on some data and start seeing whether it is a good prospect, and if so, what the deal might look like from your perspective. Um, Often the vendor will have some information prepared, some sort of memorandum of data, or there could be a Section 52, potentially if it's sitting with a real estate agent currently. So there'll be some financial reports already prepared if the vendor's, already actively trying to sell. And that'll just be your starting point to really get a gauge of the financial performance, I guess, and
Mm.
position of the business. In regards to that Section 52, sometimes there can be some other information about, the business locations, the hours of operation, that type of thing, which will just give you sort of a high level understanding of how the business actually operates day to day. And then you can request additional information and ask some questions, but you don't have to get too carried away in that first instance. Don't get too granular. There's plenty of time for that later on in the process.
Yeah, yeah. It's good to ask questions, but we don't need to know what color underpants they wear at this part in the process. So let me sort of make sure I've got um, my head clear on what you've been telling me. So, at this part of the process, it's really about forming a picture about what that business really looks like, isn't it?
Yeah, that's right. The objective is to get clarity around how the business operates, the key people, the customers, work out how the numbers fit together and get an understanding of the economic engine that drives the business. You can't even begin to contemplate making an offer until you really know what you're looking at and you've assessed it against your own criteria about what's going to work for you.
Mm, yeah. All right. So let's assume that we've done that analysis and the business that we're looking at, it seems to be ticking all the right boxes. What's the next step?
So we've just discussed that you need to get that data to help you into the position to formulate an offer. If you've got a clear picture on the risk and return profile of the business, you can make an assessment of the price and what you're prepared to offer and the key terms.
Mm. And so this sort of gets to a point that often comes up, which is, we get asked, do I need to have the business valued?
Yeah,
Can you
that's a
talk to
good.
that? Mm.
Yeah, it's a good point. It's a bit of a misconception, isn't it? I'm sure you would have
Mm.
seen it in your experience as well. When there's really no specific need to get a valuer involved at this point in time. A definition of market value that I was told, many years ago was that the market value is the price that two parties with no urgency and no influence are prepared to settle on for a deal. So, you could have three valuations come in and neither of them actually hit the mark because that's not the final price that gets settled on. So, at this early stage, there's probably not a lot of point in you as the purchaser engaging any sort of like a valuer to do the work. Maybe the vendor's already done that and that's how they've arrived at their asking price potentially, but ultimately you're only going to pay what you're comfortable with. So in my view, you could probably save your pennies there and do some of your own homework.
Look, it's a bit of a challenging one, I find, in that, there's that old saying that time kills deals, and getting valuations prepared is generally a time-consuming process. But there's also the element of, are you actually going to have access to all of the information you need for a valuer to do their work? And the answer to that is probably no at this point. But there is, depending on, I think, your level of experience, particularly with an industry or a type of business, there may be benefit from talking with a valuer to leverage their knowledge without actually having a valuation prepared, or at least not at that point.
Yeah, exactly. I mean, that's their bread and butter again, isn't it? So they'll have lots of thoughts, particularly if they're an industry specific valuer. They might have some really good insights that you can take away from that discussion as well. So in the absence of going to a valuer, normally you'd go to your accountant as the first port of call, because if there is a need for a valuer, people like yourself, Ash, we've got a network of people we can put you in touch with if need be. But otherwise, we can certainly help you get the ball rolling in terms of establishing what the business might actually be worth and what it might be worth to you. And there's a myriad of valuation techniques out there, and there's some that are industry specific. Like the accounting industry, for example.
Yeah, that's right. It's a bit interesting the way we value, or the industry values accounting businesses, isn't it?
That's right. Yeah. So, typically we're based on a multiple of the top line revenue. It could be 90 cents in the dollar, $1.10 per dollar of fees, for example, at this point in time. But yeah, every industry is different.
All right. So we've sat down, we've done our homework. We think we know what that business is worth, and we're keen to make an offer. Mick, what do we do?
There's a couple of things to keep in mind. And the first is that the price is just one element that needs to be considered when making an offer. So beyond that, you need to consider whether the deal should involve some sort of deferred consideration or an earnout potentially. Deferred consideration is really about protecting the downside risk, and the earnout is more about bridging the gap between a business's present value and its future value that may be achieved if it's on, or when it's on a rapid growth trajectory, for example. So then there's the consideration about whether there needs to be a handover period from the vendor and any other conditions that may be needed to ensure a smooth transition.
Yeah, it's a bit of, there is an element of making sure that what the business looks like now is what it is going to look like on the other side of the deal, with the vendor stepping away, isn't there?
Yeah, that's right. Particularly when there's client relationships involved, for example, it might be as simple as flicking a switch and the customer or client turns up to see a new face the next day. Often that's one of those examples you mentioned right at the start, Ash, where it can go south quite quickly.
Yeah. Well, the other biggie that I've come across is where they've got customer contracts, and as is normally the case when these are done professionally, there's clauses in there that talk about, you have to notify the customer if there's a change in control or ownership of the business. And so often these deals that get done are dependent on having all of those contracts sort of cemented to move forward.
Yeah, exactly.
Mm.
Yeah, and we might be skipping ahead a little bit, but that could be part of your due diligence as well.
Mm.
Um,
Mm.
so it can be quite common where the owner, once they get to a point where they can sniff an exit, they're going to get an offer that they're going to take, and they can see the light at the end of the tunnel, so to speak, for getting out. Then sometimes they just bolt towards that and kind of forget some of the other details. So getting a bit ahead of myself. So a couple of other things that we need to consider, of course, is finance. And is there any other conditional elements of the deal that could be subject to your due diligence process? Need to be clear about whether it's a share sale versus an asset sale. A little bit of accountant speak there, Ash. We can get carried away in that language, but
yeah, in simple terms, are you buying the business or are you buying the vendor's company? And
that's
they're
right.
two very different things, with different price tags and different risks and all sorts of things there.
Yeah, exactly. And that can then affect the price from the point of view that it changes the risk profile. If you're just buying the assets, and that's far less riskier than buying the whole company, for example, of the current business owners. So yeah, and look, above all else, it's really this part of the process, and the whole process in itself, until you agree, is going to be a negotiation. So you need to, for those that are inexperienced, you need to make sure you've studied up on your negotiation strategies. And you could also consider getting someone else involved, who has that experience to help you through that part of the process.
Yeah, that's right. Look, and it's about sort of knowing your strengths and weaknesses. Some people, they just struggle with negotiation. It's not something that they're comfortable doing. And so it's often good for them to have someone to support them. And, you can even sort of do a bit of a good cop, bad cop routine. um, but one thing I think is, that needs to be kept in mind is that 99 times in 100, you're going to have a haggle. And so just be ready for it.
Yep, exactly. Yeah, so, as you said, Ash, the negotiation technique is very important. That inevitable haggle is going to come up. But yeah, I mean, the negotiation strategy and technique itself is not something we can delve into today. It's a bit of a fine art, isn't it? And like you said, you might choose to get someone who's a bit of an expert in that.
Well, I would say it's a bit of an art and a science. Certainly, like if you go to, have a look on Booktopia and that sort of stuff, there's a load of different books all about the best way to negotiate deals and that sort of stuff. It's there really is a lot to it, and you can't underestimate how much having some good skills or support in that area is going to influence the outcome.
Yeah, and it's important to remember that you're negotiating in good faith towards a win-win deal. I mean, ultimately, that's the only way the deal is going to go ahead, is if it's win-win.
Yeah, you do have to keep that in mind, don't you? Like everyone wants to get a good deal. Who doesn't, right? But in the sale of business scenario, in some shape or form, you're going to be reliant on the vendor supporting that sale of business going through. And so, if you get one over them, you might find that it pays you back in spades on the other side of the deal while you're trying to transition that business.
That's it. Yeah.
Yeah. And I guess the other thing as well, like, people get really invested in the process, and that, it's quite understandable. Like, you found this business, you really want to go ahead with it. And um, it it can be tough to do, but you've got to know your limits and be prepared to walk away.
That's it. Exactly. Remember Kenny Rogers. You got to know when to hold them, know when to fold them, and know when to walk away and know when to run.
Yeah, spot on. And
I'm sure you've probably told a few clients to run from time to time, Ash, when the deal is just just not what they believe it is going to be.
Oh, look, it's it can get quite protracted, the negotiation, and that sort of, you invest a lot of time and money in it, and it really puts a bit of pressure on you to want to make it happen. But sometimes, pulling all the stops out of making it happen is the worst thing you could possibly do.
That's it. And that's where being an unemotional accountant can sometimes be a savior for some of our clients, who, as you said, you get so invested in it, the emotions start to come into it, and then all of a sudden the business sense gets clouded. And sometimes when you know when to run, we'll avoid a catastrophe.
Yeah. All right. So we've played our cards right, continuing the Kenny Rogers pun, but
That's it.
we've played our cards right, and we've struck an agreement with the vendor. Everyone's happy to go forwards. What's our next step?
Yeah, so at that point, it's really important to get the key terms of the deal documented, and that can sometimes be referred to as a heads of agreement. And so that's really, the high level understanding. If there's any vendor finance, that type of stuff in there, the price, just the big rocks, the big bits. You've agreed on the big things. Now we're going to start stepping into the next part of the process, and really reaching agreement on some of the finer points of the deal. So the main thing is getting that heads of agreement done, written, and signed by both parties before you really invest any more time in this process.
Yeah, so that's really about making sure that everyone is very much on the same page about what's been agreed to through that negotiation process, isn't it?
Yeah, that's right. And it gives everyone the confidence to go forward, because we've got that there. If somebody gets a little bit off track, we can always refer back to that and say, hey, this is what we agreed on. Is this next step going to be following what we've agreed on, or are we starting to deviate a bit, which could materially change the whole deal? And deals can still fall over after heads of agreement stage, can't they, Ash?
Oh, they can fall over at any stage, can't
Yeah,
they?
that's right.
But having the heads of agreement or the term sheet, whatever you want to call it, it's really helpful. If everyone signed that, it's not legally binding, of course, but it makes it hard for any party to start trying to change the rules of the game once they've been agreed to. So, and they help the lawyers too, don't they? We need proper contracts that are legally binding, and it's going to make the lawyer's job a lot easier if they've got that term sheet or heads of agreement.
Yeah, absolutely. And one of the things that these processes can really consume a lot of is time, both of the purchaser and the vendor. So you've already done all the toing and froing to get to this point. So let's document it and get it on paper, and then the vendor and the purchaser don't have to regurgitate that to each of their solicitors or lawyers. It's a copy of the heads of agreement to each party, just to review, and then obviously one party will be responsible for drafting the contracts, and that's, as you said, based wholly on the heads of agreement.
And so look, we're sort of getting to the next part, which is that we do have the term sheet, the heads of agreement squared away. We've got some more things to do now, don't we? It's sort of never ending.
Yeah, that's right. Just when you think the work's done, oh, my camera's getting a little bit confused. There we go. So there's some more important things that we need to consider, which is the due diligence, the financing, the legals and the contracts, and the structuring. So we've sort of touched on each of those in some capacity so far, but financing, you will have talked to your bank, to see whether you're in the ballpark. Now you've got the heads of agreement. Even that in itself can help start the next part of the conversation with the bank, because they know what the price is and they know what the terms are.
Yeah. So look, obviously there's a lot involved in those four areas you've mentioned there, Mick, but and we don't have time to sort of go through that. They're probably all a podcast in and of themselves, really. But can you, just at a high level, take us through what's involved in each one? So say due diligence to kick off with.
Yeah, sure. So the due diligence is really a process of verifying the information that's been provided to you by the vendor, and that's informed the deal that's been negotiated. Particularly from your side, you've got a certain understanding of how the business operates. For example, who the key people are they staying, are they going, all of that sort of stuff. And it's really, yeah, the due diligence is to give you the highest possible level of confidence that you're buying what you think you're buying, in a nutshell.
Yeah, yeah. And look, it's not just the bean counters that, like us, that get involved. It's beyond accountants, isn't it?
Yeah, that's right. So we need to get everyone involved in various elements and aspects of it. So finance people, lawyers, existing operations team, potentially if we're, buying for growth. And, we need to make sure that everybody who has to put a signature somewhere on this deal is happy with what's, just making sure everything's in order.
Yeah, things like, are the financial statements we've looked at accurate? Does the business actually own the assets that we that we think it does? And I guess there's also, and it depends on sort of harking back to what we were talking about, whether we're buying the company or the business, um, particularly there, but, are there skeletons in cupboards? Are there risks? And
Yep. Looking at employment contracts of existing employees, and are those conditions being carried over, to you, the purchaser, to make sure that those staff are keen on hanging around. So there's a lot to it.
Have they been paid right? Like you don't want to take on staff that are not being paid award rates or, that sort of stuff.
Exactly. Yeah, and it could be a really extreme example is the vendor says, yeah, everyone's on award rates, but when you get into due diligence, they're all paid $10 an hour over award, and all of a sudden you come in expecting to pay award, and they all leave because they're not getting what they used to get.
Yeah. Oh, look, you can, have that sort of stuff. I've seen a lot over the years, as I'm sure you have, and it can even just be things like environmental elements around the business. Like, I can remember one many years ago that involved a service station, and we ended up getting some environmental consultants in because of the potential liability. There was diesel spilling out of the underground tanks that we didn't know about, and we're going to ultimately take responsibility for.
Yep, for sure. Just one other common one too, Ash, is lease of premises, business premises. That's one that I know every deal that I've been involved in, that's the first question the lawyer wants. Where's a copy of the existing lease?
Yeah. Yeah. And look, that's a bit of a hurdle to clear too. Can you get that assigned? But, do you also have the sort of the tenure there in those premises, or might you be getting the boot before the ink is dried on the deal?
That's right. Yeah, exactly.
So obviously pretty involved.
Yeah. To move on to financing, Ash, which we've talked about a bit. But yeah, obviously you need to get that process started with your lender. And we know in the last few years, Ash, that process has really sort of escalated in its intensity, hasn't it? Just the amount of information that the banks are looking for these days, in order to, for them to do their own due diligence, I suppose, and enable them to lend you the funds. So, they want to review the finances, make sure the numbers stack up themselves. They're probably going to want to see forecasts, 6 or 12-month forecasts, maybe even longer, to support the deal. And so you've got to be organised when you get into this, have your own tax up to date, for example. That's a huge one at the moment. The banks pretty much won't talk to you if you've got overdue tax lodgements. So, that's, there's this, the financing stage, you'll spend a fair bit of time with your accountant, doing the projections, making sure the figures are right, make sure tax is right, tax office reports, all that sort of stuff.
And look, it's like you said, you've got to be organised and on the front foot there. And one of the best things that you can possibly do is when you're having those early discussions with your lender, ask them, what am I going to need to give you um, to get this deal over the line, so that you can actually get to work on that and be ready to roll once you've sort of got that heads of agreement signed.
Yeah, and you've probably
Mm.
seen, as I have, Ash, a fair few times where, heads of agreements are signed, but then the purchaser goes to the bank and doesn't stand a chance of getting the finance because they didn't ask that question you just said of their lender. What am I going to need to give you in
Mm.
order to get this across the line? And that's really frustrating for everybody. The purchaser will be disappointed. The vendor is probably a little bit annoyed that they've burnt up a bit of time for a deal that's never going
Mm.
to proceed. So yeah, there's a lot in that part.
Mm. Mm. And so contracts or legals, what's involved in that, Mick?
Yeah, so it's not strictly necessary to have formal contracts. So, um, but you and I, as professional accountants, would always say to our clients, go and get some legal advice and make sure you've had your
Mm.
own lawyer review the contracts that the vendor's potentially drawn up.
Yeah, look,
Absolutely.
from my point of view, you know, legally speaking, is there a law that says that you must have a formally prepared contract? Not to my knowledge, but it's not sensible. It's a non-negotiable thing from my point of view. Get a contract done.
Exactly. Yeah. And you're buying a business.
Mm.
You're not a legal practitioner who can understand all the legalese in the contract and every last dot point in there. I've seen many occasions when,
Mm.
I've reviewed a contract myself and thought that I had a good understanding of it, and then it goes off to the purchaser's solicitor, and the solicitor comes back with all of these questions that,
Mm.
you know, once they're raised, they seem obvious, but it's really hard to understand some of the language that's used in these particular documents.
Yeah, well, that's right, and they can be pretty dense, but we've got to keep in mind that the contract becomes the rule book of who's going to do what when, and it's what we fall back on if any issues arise as to how we're going to resolve it. So I think, like you sort of alluded to before, Mick, it's important that you're getting the right legal advice and make sure that you actually understand what the hell it is that you're signing.
Exactly.
Mm.
And, we talked about deferred income and earnouts and things. So the contract can not only work right up until the date of handover, it can actually extend quite
Mm.
some years into the future as well. And like you said, I like the way you said it, the rule book. If there's any problems, go back to the rule book and let's see how we deal with it.
Mm. And I guess from my point of view, and I've seen this in the wrong settings, is that some people are a bit flippant when it comes to contracts. You might have a vendor who's just, oh, I'll just sign that, but they're, they're really not committed to following it. And if you get a whiff of that, take my advice, run a mile,
Yeah, that's
because
right.
there's a good chance you're going to end up in court, and that's not a fun place to be.
And it's not cheap
Mm.
either.
No, no.
It's a good point you make, Ash, because, fundamentally the deal to a large extent relies on the integrity of both parties.
Mm.
So, you know, and again, on handover date is not the last you're going to see of the vendor. There's potentially some handover periods after that. Um, and, you're going to need to work with them for a period of time in order to have a successful transition. So, yeah, make sure you know who you're dealing with as best you can as well.
Okay, and the last item you mentioned, Mick, was structuring.
Yeah. So again, you know, structuring is largely a legal question. Your accountant can give you some advice around that as well, based on our experience and the tax implications of certain structures. But yeah, there's certainly it's quite common for us to have a conversation with a purchaser's legal advisor, isn't it, Ash, around the structure?
Mm.
We can come to them
Mm.
with a beautiful tax structure that might leave them with an element of exposure that the purchaser is not quite comfortable with in terms of asset protection along those lines. So
Yeah, believe it or not, it's not all about just paying the least amount of tax, is it?
no, that's right. Exactly. Sometimes tax is cheap if the structure doesn't work from a asset protection side.
Mm. And I think also just from an operational point of view as well, like, we're sort of, this is more general than just in the setting of buying a business, but it's not good when you see business owners who don't understand how their own structure fits together and works. It's important that operationally um, the owners understand it and run it the right way.
Exactly. Yeah, that's one of the things I like to take some time with my clients, is to make sure they understand their own structures, because the better they understand it, the better they can operate it. And then their business decisions are vastly different once they understand it and they can actually use it for what it was intended for.
All right, Mick. So surely we must be getting near to the end of this process. Please tell me.
Yeah, we're getting closer, Ash, but we're not there yet. So now we've got to work towards completion. So, in amongst the deal, there'll be some things that need to be done by.
Yeah. So we've signed all of the contracts and that sort of thing.
Yep.
Ticked off our due diligence, got our finance approved.
We know what date it's settling, but we know that there's a few things that need to happen before then. So, there could be some employee entitlements and a few other things that are conditions precedent, to make sure all of that's sorted out and understood and quantified between the parties. And there'll be other things in the contract as well. Every deal is different, but conditions precedent is really key to understand and make sure that together both parties have got a plan to execute those things prior to settlement.
Yeah, do have to be organised. Like that, the most common one is that, all the employees that are coming across with the business have signed their new employment contracts, for example. You're not going to be, it wouldn't be sensible to settle on the deal until that's done.
Exactly. Yep. So, so then there's those associated calculations that we talked about. If we're buying the vendor's company, there are a heap more complex calculations around what's often referred to as the working capital peg. So, if you're buying the company, there's cash in the bank that you're buying.
Debtors, creditors.
Exactly. Yep. So, this, once the deal's signed off on, between then and settlement is really quite a bit of work to do and some quite important tasks.
And I think, again, like this is the important part, to have the right support. So to have a lawyer that's supporting you, to have an accountant that's supporting you, because I've certainly seen deals get delayed significantly at this point because there's a bunch of reasonably technical things that need to happen before completion can occur. And, the average sort of small business person hasn't had any training or experience in this, and they're just going to really struggle on a DIY approach.
Yep, absolutely. Yeah, it's key to have your professionals in support and sort it out and on side, and make sure they've got it planned in their schedules as well, so there's no surprises.
Yeah. Yeah. All right. So, the big day arrives. No, we're not getting married, but it's sort of not that different as well. But the big days arrive, the deal's gone through. Where are we at?
Yeah, so pause for a quick celebration, Ash. There's been a lot of work up until this point.
Yeah.
But this is really where it all begins, isn't it? So we've got to get on with it. Day one. Open the doors and keep trading as if nothing's really happened.
So it's not the finish line.
No, it's the start. We wish it was the finish line. Yeah. So in all seriousness, there is a lot, to go from now. You now own the business. It's your baby. It's your responsibility. You've possibly got your first finance payment coming up in 30 days that you've got to make. So there's quite a lot for the new owner to do from this time on. So we've really got to make sure that we're executing the transition plan now. I suppose. Hopefully, we've had a bit of a discussion with the vendor. Particularly if they're hanging around doing a handover process for a period of time. And above all else, now we're the owners. We don't really want anything to go pear-shaped.
Yeah, well, that's it. Well, it's, we're paying for it now if it does. So it's important. This is, one of the things I think is really important is that as much as you can, you make sure that you're sort of clearing the path to be able to really give it the focus that it needs in the early days and support it through that. And I think also, this is a change management, to use that sort of corporate speak, this is a change management scenario. And there is, again, a bit of an art and science to that you need to make sure that you've got the right skills or the right help to do it. And I'm sure you've seen it, Mick. I definitely have. I've seen, people given advice about what to do after, like, post acquisition, and it couldn't be more wrong. And geez, does it end in tears?
Absolutely.
Mm,
Yeah,
mm,
that change management piece you mentioned is
mm,
particularly important with the staff. Make sure
mm,
you're well engaged with them. They're happy, they're on side, they share the vision with you, I suppose.
mm.
The last thing you want is for them to start looking for greener grass sooner rather than otherwise than they otherwise would have.
Yeah, look, I think it's a stressful and busy time for the vendor and for the buyer, and it's really easy to forget that when there's sort of this level of change happening, it can be a stressful and worrying time for the staff and the customers as well. And you need to make sure that they are reassured um, that it's going to be a positive experience for them.
Yep.
Mm. All right. Is there anything else that we need to remember, once we're in that sort of post acquisition period, Mick?
Yeah. So just in particular, in relation to deferred consideration or earnouts, we need to make sure that we're keeping appropriate records to calculate those payments. That no doubt that'll be an undertaking that we've made through the
Mm,
developing the contract. But equally, from our own perspective as the purchaser, we want to make sure that we're, only paying what we need to for the business and for those calculations. So it's in our interest to,
mm,
in our self-interest, I should say, or could say,
mm,
to do a good job of keeping track of that. And obviously, if there are those calculations, keeping the vendor in the loop and making sure that their expectations are managed around how the business is performing, that type of thing. So,
mm.
yeah.
Yeah, and look, I think there's a bit of expectation management involved in that. Like, there can often be some quite significant dollars at stake, and that can weigh heavily on the vendor's mind. And so, you know, there's a lot of room for conflict around earnouts or deferred settlement if things start, going off plan or not according to plan. And so, you do have to be prepared to work together so that everyone gets a good outcome.
Yep.
Hmm.
Agree.
All right,
Yeah.
Mick. Well,
Gosh.
we've been going a little while now, talking a little while, and clearly there's a huge amount of information or knowledge that needs to be absorbed in this sort of process. And I feel like we've probably only really just scratched the surface.
Yeah, I think we have, Ash.
Mm,
It's been a fairly high level discussion, and it just shows that the buying a business is a pretty serious undertaking, and you need to have the right people in your corner to help you get it right.
mm. So, look, before we wrap up, I'd just like to give you an opportunity to share a final few tips or takeaways.
Yeah. Um, so number one, research thoroughly, I think is probably a good tip. You want to make sure that you understand the industry you're getting into. If it's a new one, if it's like you're already in that industry, you want to know as much as you possibly can about this particular business. Is it the geographic location? Is it the business itself? What's its history? What's its reputation? All that sort of stuff. So, yeah, you can't really spend too much time on that element of it before you start knocking on doors and making inquiries.
Mm,
Obviously, professional guidance from people like ourselves and legal teams and banks and things like that as well You can't really underdo that at all.
Mm.
And above all else, be patient. A lot of people, I've seen it, over the years, where people see the opportunity and they think it's going to escape them if they don't act now. And it's quite easy for them to go in well and truly underdone and have a really poor outcome, just something that they don't really want, and nor are they expecting in some cases. So yeah, don't forget.
Yeah, you can't let that FOMO sort of rule you too much, can you?
Yeah,
Mm.
exactly. So
Mm.
that's it, Ash. They're the big tips.
Well, thank you, Mick. I think this has been illuminating. I hope our listeners will really get something out of this. Um, and yeah, certainly remember that preparation and diligence are key in this sort of stuff. And um, if anyone wants to find out more about the process of buying a business, they just need to reach out to Mick or ourselves at Sky. So thank you, Mick. I
Awesome.
hope we
Thanks for
can
the
talk again
opportunity, Ash.
soon.
It's been great. Thank you.
See ya.